So thank you, Thomas, for joining us. And yeah, go ahead.
Yeah, thank you. Awesome. So one moment here, just get it pulled up. It's hidden behind everything. So yeah, as Martin said, presenting Notional. I'll just kind of start with the very, very high level for folks who maybe aren't familiar. It's a fixed yield product, kind of similar to Element, but they kind of achieve it through some different mechanics, achieve a similar outcome through different mechanics. Right now, you can see it's just supporting these assets. They're a little earlier stage than Notional. Have raised 10 million and are off and running, but really are probably what I think just over 2 years old. And point being, they just launched V2. So there's a lot that happens under the hood, particularly in regards to their partnership with Compound and some other things that I can dig into. But I think one thing I really like about it, just from a pure product perspective, is they've made it very, very simple for the user, despite a lot of other things happening kind of behind the scenes in the smart contract layer. So going, a little further, their TVLs just popped, I think probably partially or primarily because this is effectively when they launched their second version, as well as the Compound partnership. So they probably got some press. They also increased their yields, etc., through like both the incentive mechanism and the Compound partnership. And so without getting into the mechanics, just covering purely kind of the benefit and the benefits to to users or lenders and borrowers. I'll probably loop back to this because everyone, after we go through the mechanics, we'll understand more clearly where this comes from. But the biggest one, I think, is just that it provides a higher yield on stablecoins without the risk of impermanent loss, particularly compared to Compound and Aave. So ran through, they've got like a really pretty calculator on their site that you can go punch in the variables and see what kind of returns you'd get. But ultimately, this is it. We just scraped it real quick for clarity and for a good overview. And so you can see, if you want to lend DAI, you're getting obviously much higher rates than you would at a Compound or Aave. I think Compound's at 4% today, so 2.5 times their rate, and again, still without the IL risk. And then of course you can actually, so that's all this is all the fixed rates. I should have marked it as such, but this is all fixed, which is great, right? Less risk, etc. You can also participate directly in the pool, and you end up with 17%, which is much better. A big chunk of that is based on their note, which is their governance token note yield. And so that's obviously variable. It's also dependent on the value of note, etc. But there is, so greater risk and reward on the liquidity pool incentive. So real quick, I'll just kind of explain, the product overall. It's pretty straightforward. It's a borrowing and lending platform. And again, straightforward from the perspective of the user, a lot going on under the hood. You can lend, of course, across these assets. They plan on adding more assets in the future, but wanted to keep it simple for their kind of initial expansion. And then, of course, you can borrow the same assets, and then you can provide liquidity to those pools. As I mentioned, Note is the governance token. This is a recently launched token, so I think it's not a super active community, is kind of what I gathered so far. So I actually went through, did a test lending transaction, and you can see, just to give everybody a sense of what's going on when you actually lend, just did 100 USDC. The gas was more than the loan, but effectively, you pending transaction, and then you end up with a loan, right? So it's very simple in appearance. You have a maturity date, and you can obviously then withdraw your loan at any time, because effectively what's happening is your counterparty is not a borrower. Your counterparty is the liquidity pool. And so the other kind of unusual element, because of their second version and the partnership with Compound is all of this. This is just a snapshot of the transaction from Etherscan. And so what's actually happening is you deposit your USDC, but then they're actually immediately depositing in Compound and then pulling that CUSDC, and that's what's going into the liquidity pool. So from the user's perspective, you have and are interacting with USDC, but basically everything and immediately gets translated into the C token, depending on the base asset. And then real quick, I'm going to bounce back just because I think it's an interesting point, and it helped me kind of frame up the entire product. There's actually a quote from the CEO. I watched a quick interview with him. He thinks of it, the entire product, as less of borrowing, lending, and more as buying and selling cash in the future. So really it's, you're taking your USDC today and you're trading it for USDC in the future. And obviously you're getting a bit more. So it's, again, similar to Element in that sense, but that was a nice, like, clean summary of how the product works. So then you get into, I guess, on the lending and borrowing side, this is where it gets more complicated, but none of this is exposed to the user. When you actually are lending or borrowing, what's truly happening, similar with the Compound token, how that's happening in the background, it's getting you're lending a C token, or you're depositing a C token into the pool instead of the actual base asset. Similar to that, what's actually happening under the hood, again, not exposed to the user, is you have these Fcash tokens. And I'm realizing I skipped over one point. So there's effectively 5 tokens really that are part of this, just your base asset, right? Which would be USDC, etc. Whatever the token is, DAI, etc. So then you have Note, which is just the governance token, and their incentive yield or incentive token that they use for liquidity providers. This is N token, similar to a C token in Compound. And then Fcash is basically when you lend and or borrow, they're also minting tokens that they consider as a category of, is called Fcash. And that's both a positive and negative cash in the future. So if you're lending, you're then given a positive Fcash token. And that's effectively what, and again, none of this is exposed to the user. So it's all more simple, but these are your Fcash tokens. It's actually the underlying asset, like, kind of coupled with the time. So for example, if in my loan scenario, I lent USDC, and then I'm also minted these Fcash tokens, which are USDC at a certain time. And so, I minted, let's say I did 100 USDC, then I get 105 USDC December 31st tokens back. These are NFTs, actually. They're ERC 1155s. So anyway, some more detail there. They're transferable technically. Right now, they don't have a UI to do so, but they are technically transferable, so you can buy and sell these positions immediately. And they're working on the UI. But point being, that's kind of this category of Fcash tokens, are these the underlying asset plus the time in the future, getting back to their buying and selling cash in the future comment. And so effectively, then what is happening is you end up with if you're lending, again, you have your positive Fcash balance, and that's what you're redeeming eventually for your return, which is your generates the fixed interest. The opposite is, of course, the borrowing, which is just the negative. Pretty straightforward, right? So if you're borrowing, you then have a negative Fcash that you need to redeem, and because obviously you owe that money instead of receiving the interest, you're paying the interest. And then the other thing I wanted to cover, LPs is also pretty straightforward. The one thing to call out is everything is fixed rate, except if you're a LP, because there's just a number of, there's 2 reasons. Both the variable rate you're getting when you are an LP, it consists of 2 things. It actually consists of the compound lending rate, as well as the trading or the trading fees that you're generating, just like a normal LP, just as if you were an LP on Uniswap. So when you deposit DAI, that's all you see, right? You're a single asset LP in their pools, but then again in the background, they're immediately turning it into CDAI. They deposit that CDAI into their liquidity pool, so then you are earning your compound lending interest rate and your and then the trading fees, of course, and then you end up with the variable. And so, kind of looping back around to the yields, you can see the LP rates are pretty good. 17% as of, I think it was today or last night, and so that's solid. It's variable, of course, and then again dependent on the note governance token. So I think I'll kind of pause there because I ran through a bunch and want to give everybody a chance to speak, ask questions, etc. But I think the big takeaways that I covered at the beginning are these, right? So you have for any given user, particularly a DAO, a company, people who have actual treasuries, you have the ability to have way less risk in terms of your managing your cash and your treasury needs while generating yield off of your treasury. You have a much higher yield on stable coins without the risk of impermanent loss. And then there's some other kind of more like esoteric benefits, of course, in regards to, they're effectively building an interest rate curve, which is really great because you have the different tenors or the different maturities and different yields. So you have those yield curves. And then, again, kind of a baseline for risk-free returns, similar to treasury bonds, if you could consider it quote unquote risk-free. There's obviously smart contract risk and some other things, but it's a pretty good baseline, a good baseline for the space. And then and then this is kind of almost repetitive from the above, actually. So I'll pause there and open it up for discussion.
Thanks. So I forgot to ask, are you involved in this project? So do you hold a token, or are you an investor to this?
No, actually none of the above.
Okay.
I've been in touch with the founders, but nothing formal.
Okay. I don't know. Ask, please. Yes.
Yeah, I just had a couple questions about the rate is determined algorithmically by the protocol for lending. Is that correct? And then does the end token is referred to as a liquidity token? Is it? It's not actually subject to a permanent loss, right? It's because it's just parked into a compound.
Correct. If I'm like understanding your question correctly, the end token is really just the redeemable, the token you can use to redeem your assets from the liquidity pool. So kind of similar to your point, because it's just parked in compound. It's not. There's no impermanent loss on that underlying asset.
Gotcha.
And real quick, if anybody has any other questions, obviously happy to jump in. Like, kind of similar, I actually watched Hassan's presentation on Element as well. Not surprisingly, I think this falls into basically the same category for Aladdin DAO users and people in the community, particularly because it's obviously not a massive degen yield, right? It's not the crazy high risk, high reward type of play, but I think it's for a subset of your portfolio, ideally, as a user, where you have stable coins, you can park them, relatively low risk, get a solid yield, better than a lot in the market, as compared to Compound or Aave, or trying to be an LP with a stable coin in a pool where there is impermanent loss. So I think it's kind of a bit of a niche use case, but one that I don't want to say should be, but very well could be a part of anybody's given crypto portfolio.
I see somehow it's like a hedge against the bear market somehow. It could be, you know, because then rates will go down on other things as they did like last, yeah, between the
exactly.
DeFi summer and this cycle. Yeah, we did see that rates go very near to zero maybe, and this could be a hedge for this basically.
Yeah, excuse me. And I think, I mean, this is not for individuals as much, what I'm about to say, but primarily I think for organizations and for DAOs, this would be incredible, right? Because you could calculate that you have the ability to cover certain OpEx costs, right? If you're paying your guilds or your swim teams or, you know, the different like sub DAOs, the teams working on things, you could cover the costs for various staff or operational costs, just based off the interest, and know that you have it covered for 6 months, and then of course roll those loans over, and just it creates a lot more you know, less risk, less volatility, a lot more certainty into certain models, which I think is really great for organizations. As we all know, Web3 and DAO tooling and all of it is very flexible and great, and it's great in that sense, but there's also a lot of uncertainty and causes a lot of extra work for organizations, constantly reacting to markets, etc. So it's a massive, I think it's a massive tool for that. And I don't, you know, not financial advice, but I think generally speaking, the fixed interest or fixed rate products like this and Element, etc., they're going to be, I imagine they're going to be very large once people kind of catch on, and there's like some of that market education and people realize some of the use cases where they can benefit, and it'll be a boring but very infrastructure like foundational product for the space overall.
Yeah, but I see that the screen is now open. Why is the lending and borrow rate so close? Normally you see more, you see more difference. You know, it's like if you on
Yeah,
10K, it's just 1% or
yeah. So you'll see they're actually identical. 10.9 and 10.9, 11.4, and this one, yeah, usually they're actually identical. And I didn't dig into the actual model, but I know that's like, sorry, they're the team's revenue model and the protocol's kind of revenue model. I know they take LP trading fees as well, similar to a Uniswap. So I think,
okay,
actually, as I say it out loud, I think that's where they make their spread, and then they've intentionally made the lending and borrowing rates are identical. Typically, I guess there's a 1% difference here, but I thought they were identical because that's actually something that they covered off in this interview that I'd watched as well. Was that they match them for lenders and borrowers, and there's no structural spread in the product.
Okay. Yeah, I think in a market downturn, I'm not sure about this, but if you hold the NFT, then in a market downtown you can sell it, you know, to the open market, because then you have something everyone wants, because you don't get this API then in a bear market on other platforms, so you could sell the position basically.
Yeah, 100%.
Yeah. So just add a point. So on the contributor call we had yesterday, right? And I think the contributors talk about the importance of, you know, Aladdin DAO allocate meaningful percentage into stablecoin yield asset, right? So we can just navigate through, you know, all market conditions. And so we have got, you know, a number of stablecoin yield products, you know, coming through the research meetings. I think starting from, you know, the Onion money, and then to and then Rari Capital, Element, and Notional, right? Should we have like, you know, a comparison across these products, right? So how we can just, you know, optimize the risk adjusted return we can get across these protocols. And also, you know, we need to take duration into consideration as well. Or should we just, you know, bring them all on board, right? Or we should, you know, have some comparison, just an analysis on, you know, which are, you know, the ideal one, the optimal structure for us to bring on.
Yeah, it's a good point. I mean, I think the comparison would be interesting for, well, for Aladdin, of course, and then also I think for everybody who's considering the different stablecoin products, particularly because there's obviously the yield to compare, but then there's kind of the more strategic elements, for lack of a better term, right? If you want to set it and forget it, or if you're going to be actively managing and want to, using the element as an example, it's like if you want to be selling your yield tokens or restaking those, and kind of like what's the yield strategy for each of the individual products, because they're obviously different given the different like tokenomics behind them. But anyways, I'm just kind of in a long-winded way saying would love to see that, and happy to contribute, particularly on the notional side.
Yeah, Thomas, great presentation. I definitely would advocate for Notional being a high priority for us to be considering. And yeah, I mean, between this and there's some stablecoin opportunities we alluded to with Element. I know one of the advantages to Notional is just that they have a token now, and so you are earning, their governance token, which I think has a fee capture mechanism. I'm not entirely sure. I need to go back and check it out, but if it does, that obviously gives it somewhat of an advantage over Element. But there's also, I mean, it's clear as day Element will have a token in the future. There's no way that any of the investors would have invested in Element without a token coming in the near future. So that's exciting. And then it also brings back, while we're talking fixed yield, since we aren't, I think, as concerned about EVM compatibility, right? I would love to compare all of this with the Terra anchor rate, because we could earn that 19.5% stable rate, and there's still some advantage if we wanted to ever do Orion in the future, if we wanted to bet on the Orion token, but I think just the anchor rate, just it stands out, and I have I'm not an anchor holder or investor. I think that 19.5%, which is intended to hold for years, is insane. So anyways, great job on this, and thank you for highlighting it.
Yeah, no, thanks. I was actually, your point on the note governance token is definitely a good one, because I was going to call out when I woke up early this morning. I had some whale, offloaded like $300 million of the token or something like that, causing this big price drop. Obviously, I should have acted from my phone. But so I was going to say that it's probably pretty likely that there's going to be a bounce back if you were going to participate and earn some note. Now would be the time, but it's already obviously returned. So yeah, so it was just a quick aberration, but I was about to call that out. Cool.
Yeah, thanks. It looks like that somebody of the Notion is looking our presentation or your presentation on YouTube, and in YouTube they made a comment that they take 50 basis point trading fees on each trade. So that's
for the revenue.
Yeah.
Gotcha. Okay, there you go. That's good to know. Thank you, live YouTube viewer.
Yeah, somehow, yeah. You have a stream to YouTube. So I also think it's not confidential, because you have the confidential mark on your sheet, but maybe it's an old sheet
over here.
Yeah, it's reading confidential in that.
Yeah, I'm not even part of the team. No, I think it was just from copying and pasting slides from somewhere. Yeah,
it's an old slide. Okay, so I don't know if there are other questions. If not, we will switch to Jason.